We are currently witnessing a statistical anomaly in the global order books that has not occurred since late 2020. While the retail crowd is distracted by short-term price volatility, the smart money is quietly positioning for a legislative earthquake that could redefine the asset class. If you are holding Bitcoin or Ethereum right now, you are standing on a fault line between continued regulatory suppression and a massive shift towards state-sponsored adoption. The rumors regarding President Trump addressing Congress with a specific focus on a new executive order for the crypto market are not just political noise. They represent a fundamental change in how the United States government views digital scarcity and sovereign reserves. Over the next few minutes, I am going to walk you through the specific details of this anticipated policy shift and the on-chain data that suggests insiders are already front-running the news. I will provide you with the evidence that suggests why this is not a sell the news event, but rather the beginning of a new secular cycle. The reality is that most investors are completely unprepared for the speed at which this regulatory pivot could happen. Let us get into the weeds of what is actually happening behind closed doors in Washington and on the blockchain. The market has spent the last 4 years operating under a cloud of enforcement actions and legal ambiguity. However, the narrative is shifting rapidly from regulation by enforcement to regulation by executive decree. When we look at the 30-day moving average for exchange inflows, we are seeing a distinct drying up of liquidity. This indicates that large holders are moving assets into cold storage in anticipation of a supply shock. The rumors circulating among institutional desks suggest that the president is preparing to announce an executive order that classifies Bitcoin as a strategic imperative for national security. This is a massive departure from the previous stance that viewed digital assets primarily as a risk to the banking system. If this executive order is signed, it effectively ends the war on mining within the United States borders. We are looking at a potential framework that incentivizes energy producers to partner directly with Bitcoin miners to stabilize the electrical grid. The data supports this theory, as we have seen the hash rate continue to climb despite lower spot prices over the last quarter. Miners are not capitulating because they know that political air cover is on the horizon. Here is why this matters for your portfolio and your long-term strategy. An executive order carries the weight of the federal government and directs agencies to stop hindering the industry and start supporting it. We are talking about a directive that could force the Securities and Exchange Commission to standardize their approach to digital assets. This removes the uncertainty premium that has suppressed the price of Bitcoin for years. When you remove regulatory risk, you open the floodgates for sovereign wealth funds and pension funds that are legally barred from entering uncertain markets. We are already seeing the preliminary signs of this institutional FOMO in the over-the-counter desk volume. The volume of Bitcoin moving off exchanges in transactions valued at over $1 million has spiked by 15% in the last 2 weeks alone. This is not retail traders buying the dip on their phones. This is high-level accumulation by entities that have information regarding the content of the president's address to Congress. If this data is helping you stay ahead of the crowd and see the market clearly, feel free to join our inner circle by subscribing to the channel. The concept of a strategic Bitcoin reserve is the most explosive part of this potential executive order. There is chatter that the order will direct the Department of the Treasury to halt the auctioning of seized Bitcoin. Instead of selling these assets for dollars, the United States would hold them on the balance sheet as a hedge against currency debasement. If the United States government officially signals that it is a holder of last resort, the game theory for every other nation changes overnight. Countries that were previously hostile or indifferent to Bitcoin will be forced to acquire a position to hedge against American dominance. This triggers a global race for accumulation that the current supply issuance simply cannot support. We must also look at the banking sector implications of such a presidential decree. The executive order is expected to outline clear protections for the right to self-custody. This is critical because it prevents the backdoor ban on private wallets that many regulators have attempted to implement. By enshrining the right to hold your own private keys, the administration would be validating the core value proposition of the entire industry. However, we must remain objective and look at the potential downsides and risks involved in this scenario. The political opposition to such a move will be fierce and immediate. We could see a scenario where the executive order is challenged in the courts, leading to a period of heightened volatility. The market hates uncertainty, and a legal battle between the White House and the judiciary could cause short-term panic. Furthermore, we have to consider the possibility that the market has already priced in a perfection scenario. If the address to Congress is vague or lacks specific, actionable mandates, we could see a sharp correction as leverage gets flushed out of the system. Currently, the open interest in the derivatives market is nearing an all-time high relative to the market capitalization. This suggests that traders are heavily leveraged to the upside, expecting a miraculous announcement. If the president simply offers platitudes without concrete policy changes, that leverage will unwind violently. The 30-day correlation between Bitcoin and the Nasdaq has started to break down, which is a healthy sign. It means the asset is beginning to trade based on its own idiosyncratic fundamentals, rather than just following macroeconomic liquidity. This decoupling is essential if Bitcoin is to react positively to the executive order, while traditional tech stocks might falter. Let us discuss the specific language we expect to hear regarding stablecoins. The executive order will likely push for dollar-denominated stablecoins to be regulated similarly to money market funds. This legitimizes the use of digital dollars and cements the role of the United States dollar in the digital economy. While this is bullish for adoption, it also means increased surveillance and stricter know-your-customer requirements. This is the trade-off between mass adoption and the cypherpunk ideals that founded this industry. The reality is that institutional capital requires these guardrails to enter the space at scale. We are also seeing interesting movements in the options market that align with this timeline. There is a significant concentration of call options with strike prices well above the current market value, expiring shortly after the scheduled address. Smart money is betting on a volatility expansion, not a consolidation. They are paying a premium for the right to buy higher, which indicates they expect a move that leaves the current trading range behind forever. If you are finding value in this analysis and want to continue navigating these turbulent markets with us, make sure to like this video to help spread this critical information. Now, let us look at the geopolitical angle involving China and the European Union. If the president announces a pro-crypto stance, it forces Europe to accelerate their own regulatory frameworks to remain competitive. We have already seen the European Union implementing the markets in crypto assets regulation, but a United States executive order would likely be more aggressive in fostering innovation. China, having banned mining and trading, would find itself in a precarious strategic position. They might be forced to soften their stance or find indirect ways to gain exposure to the asset class through Hong Kong. This creates a feedback loop of positive news cycles that could sustain a rally for several quarters. But let us bring this back to the immediate price action and what you should be watching. The key level to watch is the realized price of the short-term holder cohort. If we can hold above that level leading up to the speech, the market structure remains bullish. If we break below it, it suggests that the market is rejecting the rumor and we could see a flush to lower support levels. You need to pay attention to the funding rates on major exchanges. If funding becomes excessively positive leading up to the event, it is a warning sign of an overheated market. Ideally, we want to see price appreciation driven by spot buying, not by over-leveraged long positions. The divergence between spot volume and futures volume will be your best indicator of the health of the move. Another critical metric is the miner revenue per hash. If this metric starts to tick up, it means the network is healthy and miners are profitable enough to hold their inventory. This reduces the sell pressure on the market and allows demand to drive price discovery. The proposed executive order is also rumored to address the tax treatment of small transactions. If the president proposes a de minimis exemption for capital gains on small purchases, it would unlock Bitcoin for use as a medium of exchange. This would be a massive catalyst for the Lightning Network and Layer 2 payment solutions. Most of the narrative from purely a store of value to a functional currency for everyday life. So, What is the playbook for the coming weeks as we approach this historic address? Do not chase green candles on high leverage. The volatility during the speech itself will likely liquidate both longs and shorts who are too aggressive. Your strategy should be to accumulate spot positions on dips and verify the substance of the executive order once it is released. Read the actual text of the order. Do not just rely on the headlines from mainstream media. Look for the specific directives given to the Treasury and the Commodity Futures Trading Commission. If the language is decisive and sets clear deadlines for implementation, that is your signal that the bull market is entering a new phase. If the language is hesitant or calls for more studies and reports, then we are likely in for a period of stagnation. However, the on-chain data involving long-term holders suggests they are betting on the former. The supply of Bitcoin that has not moved in over a year is at historic highs. This is the ultimate vote of confidence from the people who know this asset best. They are not selling because they understand that the United States government is about to pivot. The integration of Bitcoin into the strategic financial framework of the world's largest economy is the endgame we have all been waiting for. It legitimizes the asset in a way that no Super Bowl commercial or ETF launch ever could. We are moving from the era of speculation to the era of strategic accumulation. The window to front-run this policy shift is closing rapidly as the date of the address approaches. Stay focused on the data, ignore the noise, and prepare for a market environment that is vastly different from what we have seen in the past. Please remember that everything discussed here is for informational purposes only. I am a strategist analyzing market trends and data, but I am not your personal financial advisor. Markets are inherently risky, and you should always conduct your own due diligence and consult with a certified professional before making any investment decisions. The future is being written right now, and the smart money is already positioned. Ensure that you are watching the right signals.